Welcome back to the Deep Dive. Today we are tearing through the Q3 2025 earnings results for Bitdeer Technologies. That's ticker BTDR. And, if you followed this call, it was anything but straightforward.
Not at all.
This is really a story about a company trying to pull off a massive strategic pivot. They're known as a Bitcoin miner, huge one, but they're trying to become this dual engine compute platform.
Right, with high-performance computing and AI infrastructure as the second engine.
Exactly.
And that's where all the confusion came from. I mean, the results were a tale of two completely different companies. You had this incredible operational growth on one side, and then on the other, just a massive amount of accounting noise that, frankly, spooked the market. So our job today is to untangle all of that.
All right, let's start with those conflicting headlines. When I first saw the top line, I thought, wow, this is a home run. Total revenue hit $169.7 million.
Which is a massive number.
It's a massive 173.6% year-over-year increase. It just crushed the consensus estimates.
It did. But here's where it all fell apart for some people. The bottom line.
Right.
The GAAP EPS was a huge miss at negative $1.28. I mean, the street was looking for something like negative 14 cents. So a huge miss.
And we saw that confusion play out in the stock price almost instantly. It popped, almost 4% pre-market on that revenue number?
Yep.
But then as people started to digest that huge GAAP loss, it reversed hard. It ended up trading down around 12% on the day.
On huge volume, too. It was a major disconnect. But this is why you have to look past the headline GAAP number sometimes. If you look at adjusted EBITDA, which strips out a lot of that accounting noise, it flipped to $43 million positive.
$43 million positive. And that's coming from a loss of about $8 million last year, right?
Exactly. So the core operation, the mining engine, it's actually humming along quite profitably. The financial structure is just making it look really messy.
Okay, so let's dig into that foundation then. The core mining business. That's where all the current strength is coming from. HOMRF mining revenue was $130.9 million. And they hit their hash rate target, actually beat it, hitting 41.2 exahashes per second by the end of October.
And that's a huge number. But what's really impressive to me isn't just the scale, it's the efficiency gains. Gross margins jumped to over 24%.
From 4 or 5% last year?
Yeah, from 4.5%. And that's all coming from better fleet efficiency and, crucially, the ramp up of their own proprietary mining machines.
The SEALMINER chips. And they gave an update there, too. The A3 series is in mass production now.
Right, with shipments expected soon. And that vertical integration is, it's everything in this business for defending your margins long term.
But the real strategic asset here, the thing that underwrites both the mining and the AI dream, is the power. It's the infrastructure.
100%. They have 1.61 gigawatts of electrical capacity online now.
And the pipeline is almost double that, right? Around 3 gigawatts.
3 gigawatts. And you have to put that in perspective. I mean, that is a colossal amount of power that they own and control. That's the real moat here.
Okay, so that power is the foundation for the second act, the AI pivot. And they made a really interesting strategic shift there. They announced they're letting the exclusivity period with their planned JV partner expire.
That was a big surprise on the call. They're essentially saying, the market for AI compute is so hot right now, we think we can make more money by doing this ourselves, using our own teams and just hiring contractors.
But isn't that a huge risk? I mean, these are incredibly complex, capital-intensive projects. They're basically betting they can do it better and faster alone.
They are. It's a big bet on execution, speed, and control. And they're pointing to their early results as proof it can work. Their AI cloud service is small, but it's already at an $8 million annualized revenue run rate.
With really high utilization too, right?
87% utilization on their current 584 GPUs. And they confirmed they're buying the next-gen NVIDIA chips, the GB300s and B300s.
So they're scaling up.
Fast. They expect to double their GPU count by the end of this year.
And the physical roadmap for converting sites, it's ambitious. The big one is the Tinset Norway site. 175 megawatts.
And that Norway site is key. It was already designed for high-performance compute. It's got liquid cooling, robust infrastructure.
So it's cheaper to convert.
Way cheaper. The conversion costs are expected to be much lower than the benchmarks you see in the U.S. or the rest of Europe. That's a huge advantage.
And they're also converting smaller sites in Washington and Tennessee.
Yep. Another 23 megawatts or so, all targeting completion by the end of 2026.
But this is where the numbers get, frankly, a little staggering.
Yay.
Management said that converting just 200 megawatts of that power could generate an annualized revenue run rate of over $2 billion.
$2 billion.
By the end of 2026.
Now, that's the bull case, the most optimistic scenario, but it just shows you the scale of what they're aiming for. It's a complete transformation of the company.
And the key to all of this is their Clarington, Ohio site, 570 megawatts.
And the power there is coming online a full year earlier than they expected. By Q3 2026, that time to power advantage is maybe the single most important part of the entire bull case.
So, okay, we have this picture of incredible revenue, strong operations, and this stunning AI vision. So why did the stock sell off so hard? Let's talk about that headline loss. $266.7 million.
Right. And this is where it gets really confusing for the average investor.
Wait, so can you just break this down? The loss was caused by a $234 million non-cash derivative loss. How? How does that happen?
It sounds completely backward, I know. It's an accounting quirk. It's tied to their convertible senior notes. Under IFRS rules, as the company's stock price goes up, the value of the option to convert that debt into shares also goes up. You have to mark that liability to its fair value. So a rising stock price actually creates a massive non-cash loss on your income statement.
So the stock going up over the last year literally caused this paper loss that completely masked the $43 million in positive adjusted EBITDA they generated.
Exactly. It's an accounting fiction, but it's one that scared a lot of people. That said, there are some legitimate concerns here around financing and cash burn.
For sure. They sold another 6.2 million shares through their ATM program.
And took on $320 million in related party borrowings.
Which you have to do to fund this kind of build out, but it definitely raises concerns about shareholder dilution down the road.
And then there's the other big risk factor, the proprietary silicon. They gave a pretty mixed update here. The first version of their SEAL04 chip showed really promising results.
Like 6 to 7 joules per terahash? Is that good?
That's very good. Highly competitive. It would be great for their margins. But here's the kicker. The next version, the Gen-2 SEAL04, is, and this is their word, significantly delayed.
Ouch.
Yeah. They said it's due to implementation difficulties, needing big changes to their design process. That's a big red flag on a really key part of our future mining strategy.
So they're burning a ton of cash on infrastructure. CapEx is still guided for $240 million for 2025. And at the same time, they're announcing a delay on a core piece of their tech.
It's a tough combination.
So when you put it all together, you can see why the market is so divided.
Absolutely. The stock is up, 145% over the last year. And that's all been driven by the AI story, the optionality.
That's the bull thesis.
But now investors are trying to weigh that massive multi-billion-dollar AI target against these very real immediate headwinds. You've got the confusing accounting loss, the dilution, and now a critical chip delay.
The entire story now really just comes down to execution. Can they hit those AI milestones on time?
All right, that brings us to our segment where we cook up an outrageous but plausible scenario based on what we've just discussed. And remember, this is just a thought experiment, not financial advice.
Roll for it.
So the core idea here is that the market totally overreacted to the short-term noise. They sold off hard on the accounting loss and the R&D spend, and they completely ignored the strategic value of that power portfolio. The fact that Ohio is coming online early, that Norway is a low-cost conversion, that makes the $2 billion AI run rate target, I think, plausible, even if they only get part of the way there.
Okay, so what's the play on that idea?
The trade would be to leverage the volatility by selling the short-term noise and buying the long-term optionality.
Meaning?
You could, for instance, consider a structured trade. Sell some short-term puts, basically betting that the intraday low holds and the panic selling was overdone. And at the same time, you use that premium to buy long-dated, high-strike call options, something targeting late 2026 or early 2027.
So you're betting that eventually the market stops pricing this like a volatile crypto miner and starts pricing it like a premium HPC infrastructure owner.
Exactly. You're betting the AI story wins out in the long run.
Interesting. A classic case of short-term pain for potential long-term gain. Okay, so let's wrap this up. The big takeaway from this deep dive is that Bitdeer is building a tremendous physical foundation. That 3 gigawatt power pipeline is real, and the site conversions are underway. That underwrites the entire AI vision.
It does, but they're taking a huge risk going it alone. And that brings us to our final provocative thought for you to think about. What is Bitdeer's true identity now? Is it fundamentally a power and real estate company that just happens to have this huge HPC option attached to it? In which case, its success really just hinges on converting those Ohio and Norway sites on time? Or is it still, at its core, a tech and silicon development company that's just burdened by all this infrastructure? Which would mean that its future success really depends on them fixing that SEAL04 chip delay.
That is the core question. What kind of company is the market going to value them as over the next 2 years? That's a great place to leave it. Thank you for joining us for the deep dive. Please remember to consult your own professional advisors before making any decisions based on our discussion today. We'll see you next time.